Hello, welcome back to another video. Today I'll be talking about the stock that I just trimmed and another stock that I just added to my portfolio. So for reference, this is my portfolio. I have a number of holdings in here, and there's actually one company that I just trimmed slightly, and this company is none other than Meta. So Meta year to date is up around 30%. It is currently trading at a 28 times earnings. So why exactly did I trim Meta? It was because of this. So their capex actually went up by around 50%. And if to compare that to their depreciation and amortization, it only went up by around 20% or so. So what this means is that Meta is lengthening the lifespan on all the different GPUs that they're buying from Nvidia and all the capex that they're spending. But if you're to consider the lifespan of an actual GPU, it is normally between 3 and 5 years. And if you're to do the math and if you're to go and account for the disparity between your capex as well as your depreciation, Meta is basically increasing the lifespan of all these GPUs from 11 years to around 22 years. So there's an argument to be made over here that Meta is actually overstating their earnings. Their depreciation is a lot lesser than what is actually happening in the company, which is why I decided to trim a portion of my position. And for Meta, the capital allocation isn't great as well. The company is spending billions of dollars to hire talent into the company, which is bad for shareholders as well, unless they can continue keeping up with this earnings growth. The company is also planning to raise debt as well as raise equity, so this is shareholder dilutive. And if you're to compare this to all your different other AI hyperscalers, the other AI hyperscalers are not doing this, they're not raising debt, whereas Meta is raising debt because the cash balance is not healthy today. Whereas Meta is trying to raise debt as well as equity because the cash balance is not healthy for this company today. So for Meta, the company doesn't have a cloud system like Amazon, like Google, like Microsoft. And for Meta, they are building infrastructure for anticipated future demand of their products. So the only way that they can integrate AI is through their products like Instagram, WhatsApp, and so on. And it isn't as large as all the other cloud computing companies. And besides that, I think the management right now is trying to take more risk just for the sake of it. Meta probably doesn't need to spend so much money on capex, but they're doing so because their AI counterparts are doing so as well. And for Meta, what if there's an actual time lag between the profitability as well as the investments that the company is making today? This will hurt shareholder returns, which is why I trimmed my position slightly. So for Meta, I trimmed it to reduce exposure for the company. The company is planning to spend $100 billion next year. And if you're to look at their operating cash flow in the trailing 12 months is only $100 billion. So they're making $100 billion and they're spending $100 billion. So that won't give any tangible shareholder returns as well. So it's a risky bet that the management is taking on. And Mark Zuckerberg doesn't have a very good history with it anyway. So that's why I decided to trim Meta and I deployed the cash into another company, which is Visa. So I added Visa at around $335 a share. Visa today is trading at a 33 times earnings, and year to date it's up around 9%. So for Visa, the earnings were quite steady. The company reported earnings just a few weeks back, and their net income increased by around 8%. Earnings per share went up by 12%. Revenue went up by 14%, which is extremely healthy despite all this tariffs that is going on. And overall, this was a decent quarter for Visa. So for Visa, this is my valuation for the company. So assuming an 11% free cash flow growth from year 1 to year 10, and assuming a 4% terminal growth rate, for Visa, this is definitely achievable. It is one of the most stable, most predictable companies out there. The company's fair value is at around $335 a share. So I added at around fair value. I decided to add it anyway because there wasn't anywhere else for me to allocate this capital. And besides Visa, I also added to another company which I'll be talking about later on as well. So for Visa, the company has been selling off because of all your crypto chatter. The stock was at $370 a share and currently it's at around $330 a share. So Visa is lagging in the markets because of all this crypto chatter, but Visa has the widest network and the widest infrastructure to adopt and implement crypto. And the company provides the service anyway already, so I don't think all this crypto chatter will cause any tangible impact to Visa, and that's why I still remain bullish on the company today. And besides that, I also added into another company, which is Warrior Met Co. So Warrior Met Co year to date is up around 15%. It is currently trading at an 81 times earnings, and I added at $51 a share, as well as $58 a share. So for Warrior Met Co, the thesis is just these two things. Number one, it will be coal prices recovering. So the coal prices have been depressed over the past few years because China has been pushing a lot of cheap steel into the market, and that is suppressing your coal prices because your steel is made of coal. And then the other thesis for the company is simply just the new mine that they're coming up with as well. So they recently just opened their Blue Creek mine, and the Blue Creek mine alone will increase the revenue of the company by upwards of 75%. So that's why I added into Warren McCool. It is a company that is slightly different from my other companies in the portfolio, but the company was undervalued, and that's why I added into the company. A quick plug as well, if you guys don't have a broker yet, then you may want to consider Moomoo. Moomoo is giving out this exclusive rewards to viewers on this channel, so you'll be getting $20 worth of Nvidia shares if you sign up with my link there and deposit $100 in your new account. This is an affiliate link, so I'll be making a small commission out of it, so if you have someone else providing the link, then feel free to use that one as well. If you're interested, feel free to sign up today. Next portion, I'll be talking about some stocks that are crashing today. So the first stock that I'll be covering is Constellation Software. So Constellation Software is a company trading at 100 times earnings, and today is down another 3%. The stock is selling off just like all your different other software companies because of the narrative being pushed online that AI is destroying software. And for Constellation Software, what they do is they acquire all these VMS software platforms for under $5 million. So that is why the market is pricing in that Constellation Software could eventually be disrupted by AI innovations in the future. So for Constellation Software, if you're to look into their earnings, revenue grew by 15%, net income decreased by 68%, and then the cash flow from operation went up by 63%. Free cash flow increased by $37 million from $182 million to $220 million. So for Constellation Software, the number that you should be looking out for is the free cash flow line. Don't look at the net income line, because for Constellation Software, they do a lot of acquisitions. And when they acquire a company, what they will have to do is to amortize all the intangibles of the company, and that will hurt their bottom line. So for Constellation Software, the number that you should pay attention to is actually the free cash flow, because it doesn't account for the non-cash expense, and that is what the management has said as well previously. And for Constellation Software today, the company is trading at a 28 times price to free cash flow. I think that's around fair value for Constellation Software. And besides that, their CEO is incredible. He's Mark Leonard. And Mark Leonard has been leading Constellation Software for many years. And I think if you're buying into the stock today, you're basically buying into his philosophy as well as his capital allocation skills. So for Constellation Software, I think it is a company that is fair value today. If you're interested in the company, then this could be a decent time for you to start looking at it. The next company that I'll be covering as well is one that isn't really talked about. This company is Wolters Kluwer. So Wolters Kluwer is down around 30% year to date. It is currently trading at a 23 times earnings, giving you a 2% dividend yield. So why exactly is the stock down so much? The stock is down because the CEO is actually retiring next year. So the CEO has been leading this company for many years, and the CEO was actually the one that was able to transition the company and inflect the company in the correct direction. So the CEO is planning to retire in 2026, and on the day that the CEO actually retired, the stock dropped by around 15%. So for Wolters Kluwer, what exactly do? They do something similar to what Constellation does, but it is slightly different. They don't acquire companies, they're not a serial acquirer. They have organic growth within all these different branches that they own. So they own a lot of different software, from accounting to taxes to even education. And this company just keeps getting in recurring revenue every single year, which helps with the predictability of the company. So for Wolters Kluwer, if you're to look at the fundamentals as well, the fundamentals look great. Operating margin is 25%, profit margin is 18%, ROIC is 16%, ROCE is 25%. So overall, this company is definitely slightly higher quality than your average S&P 500 company, but the company's business model could be a bit too complex unless you're aware of this space. But nonetheless, this is an interesting company with high predictability as well. Last portion, I'll be covering some questions left in the comments. So the first one, it says, "Hello Guan, what are your takes on Hermes as well as Meli? Would they be good buys to buy on the dip?" So first company, Hermes. Hermes is down 30%. For Hermes, I think the company is still a bit overvalued. The company is still trading at a 47 times earnings, and the earnings is only growing at around 11 to 12%. So for Hermes, despite the company being super high quality, despite the brand name being super strong, your Birkin bags, they're still a trend after all, and every once in a while the trend will flip. So that's one portion that could be concerning for Hermes. And besides that, the company is trading at a hefty valuation today, given the growth of the company. So for me, I think Hermes is an avoid today. I think the company has to fall a lot more for me to be interested. So for now, I'll be staying out of this company. As for this other company, Meli, I'm not too sure what their operations are like in South America. There's a lot of things that you have to consider if you're to invest in a company. You have to consider the South American economy, you have to consider the inflation rates there, and so on, and the take rate. So for me, this company is a bit too complex as well, and it is probably in the too hard pile. The next comment it says, too many people and investors follow Joseph Carlson blindly. If Duolingo was such a good buy, Joseph Carlson would have bought it at $67 to $120 a share. The guy literally bought it because he saw how much growth potential it had when it reached $529 and FOMOed in when it came back down to $300, and people actually followed that nonsense. He talks about subscription business model, strong fundamentals, and great management, but the guy doesn't own Uber, Adobe, Meta, Nvidia, Palantir, MSCI, or CME, Spotify, and sold Apple because of 3 years of flat growth. The guy is not an investor, he is chasing hype. He has been on mute for months when it comes to Salesforce. He's owned great companies in the past, but has sold out of them like Caterpillar, JP Morgan, Home Depot, Apple. And because the people who follow him don't educate themselves, they copy and talk about his every move. How can intellectual investors not see this and question him? So I think it is easy to point out the flaws of someone online. I mean, for Joseph Carlson, if you're to look at his track record, I don't think his track record is bad by any means. But for Duolingo, it is a company that I disagree with. I think the company is extremely expensive and it is pricing in a lot at today's valuation. And the multiple will likely contract if we see 1 quarter of growth slowing. As for him not being an investor, I think Joseph Carlson has his own track record. It's not perfect by any means. I mean, no one is perfect. I hope you guys have found this one useful and invest safe.